Okay, so if you're an investor in India, chances are your portfolio has been, well, bleeding red lately. The market's taken a serious nosedive, and it's got a lot of us asking, what on earth is happening? Well, that's what we're here for. We're going to break down the one big event that's really behind all this chaos.
And look, let's be super clear here. This isn't just some small, everyday dip. Not at all. We're actually looking at the most volatile market we've seen in over a year, and it's wiped out a huge chunk of the gains many investors have made recently.
So, why is this 10% number suddenly so important? Well, it's a pretty big deal. It means the Nifty 50, the index that follows India's 50 biggest companies, has dropped by that much from its recent high. And whenever that happens, it officially enters what the experts call a correction zone. Think of it as the market's alarm bell, signaling that something major is shifting under the surface.
Which brings us to the big question, right? Why is this happening now? What's the real trigger for this massive sell-off? Let me tell you, it's not just random market noise. There is one single primary driver here, and it's sending shockwaves all the way across the globe, hitting India especially hard. See, the root of this problem, it's not actually coming from inside India. It's a global event, a global shockwave, but it's having some very real and very painful consequences for investors right here at home.
At the heart of all this is something called an oil shock. Sounds dramatic, right? Well, it is. All it means is a sudden, sharp spike in oil prices. And for a country like India, which imports almost all of its oil, a shock like this, yeah, it can really, really hurt the economy. So what's causing it? It all comes down to the escalating conflict in the Middle East. It's sparking fears that the oil supply through a really critical channel, the Strait of Hormuz, could get disrupted. Now think about this. India is the world's third largest oil importer. That makes us incredibly vulnerable. And what happens next is a classic risk-off situation. Global investors get nervous, they get spooked, and they start pulling their money out of markets they see as risky. And right now, India is on that list. And wow, you can really see the scale of the problem when you look at the numbers. Brent crude oil prices have just surged to nearly $120 a barrel. That's the highest level we've seen since back in 2022. For India, a jump that big puts just immense pressure on everything, from inflation to the broader economy.
All right, so let's track how this global oil shock is actually creating these ripples right through the Indian market. Because it's not just about paying more for petrol at the pump, this is about a wave of fear and uncertainty that is changing how investors behave and what they're willing to pay for assets. Check out this number, a jump of over 150%. What is that? That's the surge in the India VIX, which people in the know often call the fear index. It shot up like a rocket this year, and that shows a massive spike in just how much volatility everyone is expecting. When the VIX gets this high, it's a clear sign that investors are buckling up, bracing for some really big swings. Uncertainty is at an absolute peak.
And what's happening right now is this fascinating tug of war in the market. It's really interesting. On one side, you've got the foreign institutional investors, the FIIs. They're selling off Indian stocks pretty aggressively and moving their cash into so-called safe haven assets, like gold or the US dollar. But on the other side, you have our domestic institutional investors. We're talking about Indian mutual funds, for example. And they're actually buying up those shares, soaking up the selling pressure. Why? Because they're being fueled by a steady stream of money from everyday investors through things like SIPs. And oh boy, here's another record being broken. And it's definitely not the good kind. The Indian rupee has weakened to a brand new low, crossing 92.3 against the US dollar. A weaker rupee is a big problem because it makes those already crazy expensive oil imports even costlier. It just creates this nasty, vicious cycle for the entire economy.
And this pain isn't just stuck in one part of the market. Oh no, it's spreading pretty much everywhere. The sectors getting hit the hardest are exactly the ones you'd think. Anything that's sensitive to fuel costs. Just think about it for a second. Aviation stocks, they're plummeting because jet fuel costs are through the roof. Auto and paint companies are taking a hit because oil is a key ingredient for them. It's a direct and painful chain reaction. Okay, so with all this chaos swirling around, the big question on everyone's mind is, where do we go from here? Is this just a temporary storm we need to ride out, or are we looking at a much longer, colder winter for the market? Let's dig into some of the potential scenarios, and believe it or not, maybe even a few silver linings. Really, the market's future right now hinges almost entirely on two things, that geopolitical crisis and the price of oil. This table kind of maps out the possibilities. In a best-case scenario, if the conflict cools down and crude oil drops back below $95, we could see a really nice recovery. But on the flip side, if the war drags on, a slide down towards the 22,000 level for the Nifty becomes a very, very real possibility.
But, and this is a really important but, despite all these external shocks hammering the market, the Indian economy itself has a really strong foundation that's actually preventing a total freefall. This underlying strength is a crucial part of the story that we can't ignore. I mean, let's not forget the basics here. India is still one of the fastest growing major economies on the entire planet. Domestic investment is strong, that SIP money is still flowing in, companies are still in a spending cycle, and our banking system is pretty solid right now. All of this together creates this powerful domestic cushion that's absorbing a lot of the shock and frankly preventing a much, much steeper fall.
All right, so let's tie this all together. What does this all mean for your money, for the average investor? In a market that feels this chaotic, what's the right move? Well, the good news is the advice coming from the experts is actually pretty clear and consistent.
And the number one message, loud and clear, is this: don't make rash decisions. Don't panic sell. Selling when everyone else is panicking, especially when prices are low, is often the quickest way to lock in your losses. The focus really needs to shift away from trying to time the market in the short term and back to solid, long-term fundamentals. Yeah, Equity Master puts it perfectly here. The real advice right now is to just ignore the daily noise and get back to the basics. Ask yourself the simple questions. Is the company I'm invested in actually strong? Is it well managed? Because in the long run, those are the questions that really matter, not the panic of the day. And that really brings us to our final thought. Look, a market correction like this is always unsettling. It's never fun, but it can also create opportunities. This kind of volatility can be a chance for long-term investors to pick up quality companies at much more reasonable prices. So maybe the real question isn't just about how do I survive the storm, but rather, in this sea of red, where can I find the opportunity?